Welcome. J.P. Morgan Chase & Company has agreed to pay $153 million to settle civil fraud charges related to mortgage investments just as the housing market was collapsing. Here to discuss this is Peter S. Cohan. He is a market analyst and venture capitalist and author. Good to talk to you. Welcome back, Peter.
Thanks, Scott.
Since J.P. Morgan Chase netted about $17.5 billion last year, does this seem like it's anything more than a wrist slap for them?
It is a wrist slap, but it's kind of an interesting one because basically it suggests that they were selling their investors down the river. And it brings up a sort of a broader issue, which is how do banks really make money?
Well, they're doing a good job of still making money. So this scenario was getting people to invest in a hedge fund, people like General Motors and a Lutheran financial organization among them, and saying, yes, this hedge fund's going to be great. Then on the other side, they're betting that the hedge fund is going to fail, and it does very well. And that is that a common practice among all these banks? Is that what they do?
Well, this is a very interesting phenomenon. I guess I've been studying what's been going on with their earnings this year, and they're not very good, and they're planning layoffs. And one of the reasons for their poor earnings is because part of the Dodd-Frank law that passed to sort of change the financial regulation of the industry was that they couldn't own proprietary trading funds. It's a lot of it is very mysterious, but essentially, if you are a big bank and you see all this order flow, you know the positions of your customers, you know the positions of all your clients. And under the guise of hedging, you can use the information that you have about their positions to bet against them. And you can make some very, very profitable bets that way. Essentially, it's a form of legal inside information that I've called insidery information. Is it strictly illegal? I don't know. Is it in the best interest of the clients? Absolutely not. Is it in the best interest of the company's short-term trading profits? Absolutely, if they can get away with it. But since they've been forced to spin off their proprietary trading, this is cutting into their earnings.
Mm-hmm. Well, I mean, from an ethical standpoint, they obviously pretty much know that this hedge fund, for example, using it as the focus of the conversation, they know it's going to fail. Yet they are really trying to get people invested in this. That just does not, I mean, whether it's legal or not, it's not right, is it?
Not at all. Not at all. I mean, I personally count me among those who cannot understand why anybody would pay a financial advisor for anything. Unless that financial advisor is giving you, say, tax advice on an hourly basis, rather than getting paid a percentage of the transaction and having a financial incentive to churn your account, I cannot see why you would want to pay them. I mean, the fact of the matter is, I do not consider myself to be a market expert to know why stocks go up and down. And I've been studying this for decades, and I don't know what moves prices. I'm fairly convinced that nobody knows what moves prices, and yet they kind of hold themselves out as experts and charge people fees, regardless of whether they make money or not, for that expertise, and yet they don't really know whether the investment is going to make money or not. So, they have a financial interest in churning your account because they get a percentage of the amount that's in your account, or they get a percentage of the amount of trading that's going on in your account. So it seems to me that you would be better off in general, and these investors who invested with J.P. Morgan on this so-called squared CDO 2007-1 transaction that was happening in March, April 2007, they would have been better off probably just taking that money that they put in there and buying an S&P 500, low-cost S&P 500 index fund, in which case they would be paying no transaction fee, and they would be paying very low expenses, and they would be earning the market average return. And most individual funds and stocks cannot beat that market average.
Mm-hmm. I guess at least the good news is from the settlement is that the money will go back to pay the investors who lost money here. But I mean, this probably. What do you think? Does this really force a bank to change the way that they do business?
No, it really doesn't. Basically, it is a slap on the wrist when you when you look at the fact that no individuals that were responsible for this were actually punished for what they did. And today I was reading that there was a particular individual at J.P. Morgan who was responsible for picking the securities that went into this, and the company was clearly desperate to unload this, and so somebody was directing the sales force to tell investors that this was a great investment, knowing that at the same time they were trying to get rid of it and get it off their books. So there was, obviously some conscious deception on the part of J.P. Morgan, and there's nothing here to stop them from doing that again. Unless they think that $150 million is a price they don't want to pay the next time they have to do that.
While we have you on the phone here, I also want to cover a piece you wrote on QE2. The Fed is wrapping up its $600 billion Treasury bond buying program at the end of this month. And you've written a pretty interesting article regarding this, really saying that the media, in some ways, is showing that incorrectly the results of this quantitative easing. And I think it really, I guess your point is that there probably could have been a better use for the money, and maybe we're not really in store for a QE3.
Yeah, I mean, I basically looked at an article in today's Wall Street Journal, and that would be, today is Wednesday, today's Wall Street Journal, and they were analyzing QE2, and the basic argument was that, hey, look, QE2 stopped deflation, drove up the stock market, and also was responsible for slowing down the economy. And then when you actually look at each of those claims that were being made here, I mean, you can see that they're all pretty shaky. The deflation wasn't happening in November 2010. There was a 1.1% inflation rate. It's now up to 3.6%. But what did QE2 have to do with the increase in inflation? What really caused the inflation was commodity price increases, and what caused the commodity price increases was traders who could borrow money with very little of their own money down to control, and they control 81% of the trading in the commodities exchanges. They were able to make these high leverage bets on rising commodity prices and a declining dollar. What stopped the price of oil from going up was the commodities exchange, the CME group, demanding higher margin requirements. In other words, these traders had to put more of their own money down. As soon as they did that, the prices fell because it became a less profitable trade. The other part of inflation, labor rates. Labor rates came down in 2010, down at 2.8% in the fourth quarter. That had nothing to do with QE2. So the fact of the matter is that, yes, inflation came up, but it didn't have anything to do with QE2. The stock market, here's the thing that really I find really silly, is that the market's been up 24% since August 2010, when the Fed decided to announce that they were going to do this QE2. Now, what he's suggesting in the Wall Street Journal is that may have helped push stock prices higher. I would argue that nobody knows what makes stock prices go up and down, and so for him to make this claim is ridiculous. And as far as the growth slowdown, I don't know how QE2 contributed to that. I mean, I think that the rise in the price of oil was up $30, during the first quarter, and that for every $10 of increase in the price of oil, you get a 0.5% reduction in the GDP growth rate. So you went from 3.5% to 2%, which is probably what you had in the first half. So all of this to say that the Fed did this $600 billion stimulus program with the idea of reducing the unemployment rate, boosting job creation, and trying to make sure that we didn't get into a deflationary environment. Well, I'm not saying that there was any impact on inflation from QE2, but if there was, they succeeded on that front. At least there is, the risk of deflation has gone down. On the other hand, the job market is still terrible. Over 9% unemployment rate in November and of last year and May of this year, and very few jobs being created.
With the recovery momentum, stopping essentially for some reason, do you think, as you say in your article, if that $600 billion had been given back to consumers in the form of, for example, a tax cut, would there have been any better results?
Well, I think so. The reason I say that is because 70% of economic growth in our country comes from consumer spending. And consumers would have spent some of that $600 billion if they had it. There's always some. They'll save some. They'll spend some. But let's assume that they spent, say, $500 billion of it. That would have added to significant economic growth. I mean, there's even a multiplier effect. If consumers spend, that creates all sorts of additional economic growth, maybe even beyond that dollar of spending. So it could have, boosted the economic growth to, maybe 3 or 4%. Could have had a significant economic impact.
And do you think that consumer buying power would have actually helped job growth as well?
Well, it makes sense if you have more demand for consumer products. That means that the factory that makes those consumer products may actually have to add to their employment base because they need to hire more people to make the products. So that could in turn create more people with more income who would then buy more, and then it kind of jumpstart demand and jumpstart growth.
You can find him at petercohan.com, among other places. Peter, a pleasure. Thanks for sharing your time with us.
Thank you, Scott.